A few years ago, a financial firm analysed the accounts of 10,000 investors over a 20-year period. They wanted to know what separated the top performers from the rest. The results surprised them. The best investors weren't the ones who picked the hottest stocks or timed the market perfectly. They were the ones who did almost nothing. They bought low-cost index funds, invested consistently, and left their accounts alone. Their boring strategy outperformed 80% of active traders. The world makes investing sound complicated. Open social media, and you'll see thousands of opinions. Buy this stock, sell that stock, watch this chart, predict the next market move. Every day, someone claims to have discovered the next big investment strategy. And if you're trying to build wealth, it can feel overwhelming. You might think you need to learn everything before you begin: stocks, bonds, options, cryptocurrency, economic trends. It's easy to believe investing requires expert knowledge, but here's something surprising. The strategy that has built the most wealth for ordinary investors is also one of the simplest. In fact, it's so simple that many people ignore it because it doesn't feel exciting. First, let's talk about a common mistake. Many new investors believe the goal is to find the next big winner. They search for companies that might explode in value, follow market predictions, chase trending stocks. Sometimes this works, but often it doesn't, because predicting the future of individual companies is extremely difficult. Even professional investors struggle to do it consistently. In fact, many actively managed investment funds fail to outperform the overall market over long periods. That's not because professionals lack intelligence, it's because markets are incredibly complex. Thousands of investors around the world are constantly analysing information, prices adjust rapidly, and opportunities disappear quickly. Trying to outsmart the entire market is harder than it looks. Let me give you a concrete example. In 2020, a popular electric vehicle company saw its stock price rise over 70%. Many individual investors piled in, expecting the trend to continue. But over the next 2 years, the stock dropped by more than 50% at one point. Those who bought at the peak lost a significant portion of their investment. Meanwhile, someone who simply bought an index fund that included that company along with hundreds of others saw steady growth without the dramatic swings. The index fund investor didn't have to predict anything. They just stayed the course. This is why many experienced investors follow a different strategy. Instead of trying to beat the market, they simply buy the market. This is where index funds come in. An index fund is a type of investment that tracks a large group of companies. For example, an S&P 500 index fund invests in the 500 largest companies in the United States. Companies like Apple, Microsoft, Amazon, and hundreds of others. When those companies grow, the index fund grows. Instead of betting on a single company, you benefit from the overall growth of the economy. This strategy has several powerful advantages. First, it's diversified. When you invest in hundreds of companies, the failure of one doesn't destroy your investment. Strong companies offset weaker ones. Diversification reduces risk. Second, it's low cost. Index funds usually have very small management fees, and over decades, lower fees can significantly increase your total returns. Third, it requires very little time. You don't need to analyze individual companies or monitor the market daily. You simply invest regularly and allow time to do the work. Let me show you why low costs matter so much. Imagine two investors each invest $500 per month for 30 years at an 8% average return. One pays 0.1% in fees, typical for an index fund. The other pays 1% in fees, common for actively managed funds. The low-fee investor ends with about $745,000. The high-fee investor ends with about $600,000. That $145,000 difference is simply from fees. The simplest plan keeps costs low. Now let's talk about the second part of this simple plan: consistency. The most effective investors don't try to time the market. They don't wait for perfect conditions. They invest regularly, month after month, year after year. This strategy is often called dollar cost averaging. It means investing the same amount of money on a regular schedule. When markets rise, your existing investments increase in value. When markets fall, your new contributions buy more shares at lower prices. Over time, these fluctuations average out. The key advantage is psychological. Dollar cost averaging removes emotion from investing. You stop worrying about whether today is the perfect moment to invest because the system keeps working regardless of market conditions. Imagine two investors in 2008 during the financial crisis. One stops investing because the market is crashing. The other continues investing $500 per month. Over the next 2 years, the second investor buys shares at deep discounts. When the market recovers, their portfolio surges ahead. The first investor misses that recovery because they were waiting for the right time. Consistency beats timing every time. Now let's talk about the third element, time. Time is the most powerful force in investing because time allows compounding to operate. Compounding means your investment returns begin generating additional returns. In the beginning, growth may seem slow, but over decades, the effect becomes dramatic. Let's look at a simple example. Someone invests $500 per month into a broad index fund, earning an average annual return of 8%. After 10 years, they might have around $90,000. After 20 years, around $300,000. After 30 years, around $745,000. And after 40 years, over $1.5 million. The remarkable part is that much of this growth comes from compounding, not just contributions. This is why starting early matters so much. Every additional year allows compounding to work longer. But even people who start later can still benefit, because the key ingredient is consistency. Let me illustrate the cost of delay. Investor A starts at age 25, invests $500 per month until age 65. Total invested $240,000. Ending portfolio at 8%, about $1.5 million. Investor B starts at age 35, invests the same $500 per month until age 65. Total invested $180,000. Ending portfolio about $745,000. That 10-year delay cost them over $750,000. Time matters more than the amount you invest. Market volatility worries many new investors. Markets rise and fall constantly. Some years produce strong gains, other years produce losses. These fluctuations can feel uncomfortable, but they are a normal part of investing. In fact, temporary market declines often create opportunities. When prices fall, consistent investors buy shares at lower prices, increasing long-term returns. Historically, markets have experienced many downturns, recessions, financial crises, political uncertainty, yet over long periods, markets have continued trending upward because businesses innovate, technology advances, productivity improves, and economic growth continues. Consider this. From 2000 to 2020, the S&P 500 experienced two major crashes: dot-com bust and financial crisis, and a global pandemic. Yet an investor who simply stayed invested through that entire period would have seen their money grow roughly 4 to 5 times over. The worst days and the best days often happen close together. Missing the best days because you tried to avoid the worst days destroys returns. The goal of this strategy is not excitement, it's reliability. Many exciting investment opportunities also carry high risk. The simplest strategy often appears boring, but boring strategies can produce extraordinary results when applied consistently. Let's summarize the simple investing plan. Invest in broad index funds that track the overall market. Invest consistently using dollar cost averaging. Allow time and compounding to work. That's it. 3 simple principles. No complex predictions, no constant trading, no need to monitor the market every day. Just a system that quietly builds wealth over time. Once this system is in place, something interesting happens. Investing becomes routine, just another part of your financial life. Like paying bills, like saving money, like planning for the future. And when investing becomes routine, consistency becomes effortless. You stop worrying about short-term fluctuations and focus on long-term progress. Over time, that progress becomes visible. Your investments grow, your financial confidence increases, and the complicated world of investing begins to feel surprisingly simple, all because you followed a plan that works quietly in the background. A plan so simple, most people overlook it, but powerful enough to build wealth for anyone patient enough to follow it. If you're new to investing, start this week. Open a brokerage account or a retirement account like an IRA or 401k. Choose a low-cost index fund that tracks the S&P 500 or the total stock market. Set up an automatic monthly contribution. Even $100 is enough to begin. Then ignore the noise. Don't check your portfolio every day. Don't panic when markets drop. Just keep contributing. Over time, that simple plan will do more for your wealth than any complicated strategy ever could. Thank you for watching. If this simplified investing for you, consider subscribing so you don't miss the next one. And I'll see you there.